How to pay yourself as a business owner right away, right? Most business owners don't actually know how to pay themselves properly, and that mistake can cost you thousands in taxes. If you have an LLC and you're thinking about becoming an S-Corp, this video is for you. Because here's the truth, right? Profit does not mean you can just transfer money to your personal account and call it a day. There's a difference between owner's draw versus payroll. If you're an LLC and you're taxed as a sole proprietor, I repeat, you do not have to run payroll yourself. Oftentimes, I see LLC owners putting themselves in payroll and they don't need to do that. Actually, they don't have to at all. You can take what's called an owner's draw, right? That is simply literally taking some of your profits and transferring it to your personal account. Now, here is what most people don't realize, right? Owner's draws are not expenses. I repeat, owner's draws are not expenses. They do not reduce your taxes. And you are pretty much taxed on your profit, whether you withdraw or not. And the easiest example I could use about this is, let's say I have $100, right? I had $100 in revenue and my expenses are $20. And then I take a $10 draw, right? So that's literally $30 right there, right? So 100 minus 30 leaves you $70 in profit. You're only paying on what's the profit that's left, which is $70. You're not paying on the $10 that you took as an owner's draw, right? So now let's use that same example and said you had $100, right? And you took an owner's draw of, let's say, $60 out of that $100. Then your profit drops to $40, right? So now you're only being taxed on the profit that's left in your business, right? It depends, I would say, what you're trying to do. I wouldn't take a whole bunch of distributions and make it look like I have literally probably $20 or $0 like of profit, because at the end of the day, the IRS wants to know if your business is profitable. If you show a loss for 5 consistent years, then the IRS is gonna have a red flag against your business and be like, well, why are you in business for so long and you have continuous losses, right? This will trigger an audit, literally. So, you're taxed on the transfer. So, in the election, in regards to an S corp, right? S corp, what most people need to understand with an S corp, you must run payroll for yourself. You have to pay yourself a reasonable salary. What S corp allows you to do as well is also take additional distributions on top of that salary. So remember, LLC owners equals owners distributions, and S corp is payroll plus distributions. When does an S corp make sense? An S corp, like most people would say, oh, S corp, I'm going to save a whole bunch of money. It's not a magic tax saving button. It only makes sense at certain income tax levels, right? Typically, if your net profit in your business is consistently 50 to $70,000 for the year, then that's when we can start having that conversation. Not just hitting it one time, two times. It has to be consistently. Why? Because we must pay ourselves, like I said, the reasonable salary, and payroll comes with cost. There are payroll services, filing, and also compliances. If your profit is only $20,000, then an S corp might actually cost you more than it saves you. Also remember, an S corp is a tax election. It is not a business entity. You can be an LLC and elect to be taxed at an S corp. That decision is strictly yours, and it shouldn't be trendy because the latest guru is telling you to do it. So remember, with self-employment tax, if you're an LLC sole proprietor, you pay that 15.3% employment tax, right? That covers Social Security and Medicare. And on top of your regular income tax. So if your business profits 80,000, then you're paying self-employment tax plus federal income tax plus a possibility plus possible state tax. Now, here's the S corp savings and how it comes in, right? With an S corp, you only pay self-employment tax on your salary, not on your distributions. That's when the strategy matters. But again, it has to make financial sense, right? Oftentimes, entrepreneurs that I often see this, they do not set up quarterly estimated payments, right? They're either being paid a whole bunch of 1099s or they're getting all this income from other sources and they have zero taxes being taken out. And this can get you into trouble really quickly because now if you are not on payroll, no taxes are being withheld, the IRS wants this money quarterly, right? So the quarterly months are April, June, September, and January. If you wait to pay everything all at once, you will probably have penalties associated with it. That's why it's important to start tax planning and be proactive and not reactive, right? You should know your numbers before the year ends. You should get a reliable QuickBooks Pro advisor like myself who can help you organize your profit and loss and your balance sheet and help, tailor your needs to your business. It's important to know your numbers so you can strategically make those decisions so you can understand what products are selling, what services are selling, and where you're in the red and where you're losing.